Just 'cause I ain't never had no nothing worth having, never ever, never, ever.
Hi everyone, this is Craig, the options linebacker, and this is the weekend report for Sunday, November 15th. Well, like the slide says, we have a battle on our hands right now, and it's going to be at S&P at 1100, just over 10,400 on the Dow, Russell 600, and on the transports at 4,000. Let's go take a look at the charts. First, let's look at the Dow and the Russell 2000. The Dow is on the left-hand side, and you can see that the price is very close to some overhead targets. We have the 50% bear market Fibonacci retracement. So for the whole bear market, it's bounced back 50%, and that level is at 10,331. Now the weekly high was 10,341, so we've actually touched that target already. Now the weekly breakdown pivot is at 10,365, which is just overhead. Now what does that mean? That means that this is that 1, 2, 3 signal here that happened between September and October of last year, which is that weekly breakdown pivot. So it's been within about 20 points of touching that target. So this kind of looks like this is when you have this level, is you have a 1, 2, 3 signal, and then the market does whatever it's going to do, and then very frequently it'll come back up and back test that area from underneath on the first move up. It acts like a magnet. What we have to figure out is what the overhead supply is up here. In other words, how many people from a year ago were actually still long at 10,500 or 10,400, those levels, and swore to themselves that the very second that the price got back up to these levels again, they would flatten out and go to cash. That's what creates this overhead supply. It makes it very difficult to get through these zones on the first time. On the right-hand side is the Russell 2000. It's actually formed a marginal lower high up here during the month of October, made a lower low in early November, and has now come back up to a very important point. Again, the line of defense here for me is around Russell 600, and I'll show you why in a minute in more detail. Now I mentioned the transports at 4,000. Why the transports? Well, this is the other half of the Dow theory. So if the Dow companies, the Dow Industrials build a product and the transports ship it, and if both are making higher highs and higher lows, then in Dow theory speak, that's a primary uptrend. They're both confirming each other. But right now the transports are not confirming. They made a lower low and are still showing as a lower high. So right now the transports are not in a primary uptrend, although the Dow is. So the very minute that the transports start working their way above 4,000, above that heavy resistance there, then both charts will be in a primary uptrend. It will be both in sync. Obviously the question with the transports is how much overhead supply is sitting up here at 4,000. Based on the double top, you'd have to say quite a bit, but if there is some kind of compelling event that pushes it up above 4,000, then you'll see quite a strong move just because of the short covering up here. Now let's turn our attention to the S&P 500. I like this particular chart because it's showing the average true range is actually starting to expand quite a bit lately, and you can also see this broadening pattern. So as we've come up here, each of these swings has started to get bigger and bigger and bigger, and it's almost like, for those of you that live in an area of the country that features winter, it's like driving in the snow, is that you're becoming a little bit more and more unstable as you get into a spin here. So what we do expect is at some point a big move will show up out of here. And at this point we don't know whether it's going to be a blowout to the upside or it's going to be a strong move to the downside, corresponding with that weekly pivot that we've been talking about at 950. We do have two competing technical views here. The first is that this is potentially showing a cup with handle pattern. So you see the cup here, and then the handle is a low volume pullback, a little bull flag in the middle of that, and then as volume comes in over 11,000, you'll see a very, very strong move from, again, all the short covering that's living up in this area here. The second possibility, though, that I'm seeing is that as we've come up on this uptrend, we're starting to round over. In other words, we're starting to see the tops become just a little less defined on the top side, and it's losing strength as it gets up to this 1100 area. Let's go back to the Russell for a second and look at the wave structure. We've gone from a higher high to a lower high. So this is wave 3 to the downside. We were coming up wave 4, and we're looking for wave 5 to the downside. Now, what's important here is the 61.8% fib. If the price stays below there, then it's more likely to come down and at least put in, if not a lower low, then at least a higher low. Now, where would that higher low start from? Well, there's three candidates. The 38.2% fib of this move here, so from the bottom to the top, the 50% fib, and then it could go as low as around 559 here, or excuse me, 569, about 570. So this is kind of the area of truth right in here, this area right here. So if it's able to bounce at 580 and start working its way up, then we'll watch that 61.8% fib right around Russell 600. And if it does get past that, then what it's saying is it's establishing a new wave structure to the upside again. However, if it falls down here, it can go as low as around 570 and still be in that higher low candidate. But if it breaks through 570, then it's on its way down here to make a lower low, and the Russell is going to lead the market lower. So in the meantime, watch this zone in yellow for clues on where the market's going to go from here, at least in the Russell. And if it never gets down in that area, then watch this zone in here between 580 and 600 to see whether or not it can break through the 600 level. So let's talk position management for a second. We've already taken profits on our upstairs call spreads at S&P 1160 or 116 on the spiders. So we've already taken profits on here. We've reduced our risk. And all we really have at risk left for the month, with 5 days left to trade, are these put spreads down here with a short strike at Spider 91. That's a long way away, so we're just going to let those expire worthless. The only thing I have to do is to manage this butterfly here to, if we get a breakout above here, then I'll close this down for a profit, which will pay for the early exit on the overhead call spreads. Now for December, we have call spreads up at 115 on the spiders and down here at 93 on the spiders. Both of them have a butterfly position acting as an active defense, but I'm going to augment that with a synthetic hedge. If the price is going to jump above 1100 on the S&P, I'm going to employ a synthetic stock hedge to help assist with the defense of this position in case we have to roll it out and push it up forward. I do cover how to set up those trades in the newsletter. I'll finish up today by looking at the November options chain of the spiders. Now, because this is OPEX week, there's still a lot of out-of-the-money short positions that are at risk. So we have the puts here, and these are out-of-the-money positions right here on the puts. And with the calls, here are the out-of-the-money open interest positions that we're looking at with the calls. So of particular interest have been the calls, especially since March, because they've just been blown over every OPEX week. We have a lot of out-of-the-money open interest on calls, which are at the S&P 1100, 1110, 1120, and as far up as 1130. To hedge these positions, generally what you're doing is you're buying a long instrument, such as a long futures contract, or you're buying the stock, which helps push up the price against these positions. You could say the same thing for all of these out-of-the-money puts down here, and those would be hedged by short futures contracts or shorting the stock. However, there's been such a floor of support down in this area that I don't think that's going to happen. So these are the ones that we're going to have to watch this. So that's it for this weekend, and thanks for watching. Make sure that you tune in next week for more in the markets. Really quick before you go, we just released a new product called Traders Fast Track, which is an inexpensive trading success program. If you go to the link in blue, we have a special offer where you can get our premium daily newsletter free for a whole month at optionslinebacker.com/fasttrack2. We also have some brand new free stuff for you. When you go to that Fast Track page, you can sign up for a free monthly newsletter dedicated to how successful traders operate, our Fast Track newsletter. You can also instantly download our brand new ebook for free, Technical Analysis for Options Traders, which shows you how a few simple yet powerful reads in the market can help improve your options trading profitability. Good trading. See you next week.